Thank you everyone for joining in. We can start taking the questions without wasting any time. You can use the hand raise feature. This is an Ask Me Anything session. You can ask anything about angel investing. I'll be happy to answer all your queries.
Yeah. So I think my question is related to the guidelines of angel investing. I was going through the circular, which is I think recently released by the SEBI, where they are saying any angel investor, when they're investing, they have some sort of minimum investment guideline where they have to invest up to 25 lakhs years in the period of 5 years, right? But when we are signing ND or any sort of documents, right, from startup lane, I think that sort of guidelines are not being shared by you to angel investor. So my question is sorry, let me finish. So I have like two questions regarding to that circular. What is the I can say pro and cons when somebody following it, or if somebody not follow, then what is going to be happen with this existing investment? Are they going to freeze or any sort of penalties? I'm not sure, right? Because I didn't able to find any concrete answer.
So what you are reading is the fund guidelines, angel fund. Okay. So angel fund has a commitment of 25 lakhs. What we are following is a private placement without the angel fund, because we don't want to put in carry. Getting it, Girraji?
Yeah, I got it clearly.
So
I got it.
So what happens is, in a fund, there is a commitment. Suppose you go to angel list and invest, or any other fund. Then as per the SEBI guidelines, you have to invest 25 lakhs to the same fund in a span of 5 years. All right. Now, because we are facilitating direct investment into the startup, and the startup has a Startup India certificate, we are following the entire Section 42 guidelines of Companies Act, wherein a new account is opened, they open up the private placement. All those guidelines are followed. Right? If those are not followed, then a chartered accountant will not even sign. Right? There is a compliance team. Then the share allotment happens. So there are, and multiple times it has happened, not through RCAs. So these in compliances are followed by the CAs of the investors as well as the CAs of the startups. So there are multiple people who are following these compliances. Right? This is mandatory for the fund, not for direct investment. So we are acting like a platform, but there is a pressure on all the angel networks to convert into a fund. Maybe we also have to file the fund very soon, but right now it has more control to the investor. You have direct equity. Your name appears into the company's cap table. Plus, you don't pay any carry. So for people who don't understand carry, let me tell you, carry means it is the profit sharing that you pay to the fund for creating the fund or for managing everything. So what happens is, fund will sell off the equity at the time of exit and take 15%, 20% from the sale proceeds in terms of profits. Kirraji, clear? Any
Sir, very much clear. Yeah. Just want to ask one thing. If you don't mind, can I quote some example here, like competitor startup lane?
Sure.
Okay. So, like you rightly said, yes, there is a two way of investing. One is PPS, private placement service, right? And secondly, through the funds. So let's say example of WFC, right? If they are sharing any deal, right, and they are allowing you to invest in the company through the second mode, where you are investing in the company using WFC platform, but you are acting as an angel fund itself, right? Where then you have to comply with that 25 lakhs sort of rule. And you rightly said, every investment when you are going to make in the company, they're going to attract some sort of carry fees when you are exiting on the profit. So let's say example, I invested 1 lakh and that 1 lakh become 2 lakh. So 1 lakh is a pure profit. So out of that 1 lakh, based on my agreement signed with them, I need to give that carry fees to the platform who introduce me to the opportunity. So how it actually work, right? Like what is the difference when you directly investing and direct and not investing through direct way, like private placement and the normal one, like which is better, not better? And
It is just like buying a mutual fund and buying the shares. Okay, this is the difference. Is if you buy a mutual fund, you don't have complete control. A fund manager decides on your behalf, but here it is not diversification. So if your investment is going through an angel fund, it is like going in the same company. Nobody is deciding this, but they will decide when to exit. Those decisions, compliance decisions, voting rights, everything will be decided through the fund only, right? So you are giving your power to the fund to manage. But if you compare it with direct investment, you become a shareholder, just like you invest into a company through stock market. So you have the voting rights anytime, any changes, any structural differences, any compliances, everything, they will have to come to you and take your approval for that. But in the otherwise case, it's not like that. They will not come to you. They don't have to take your approval. They will just deal with the fund. Both pros and cons are there. So the biggest advantage going through a fund is for the startup. That advantage is that they can save entries on their cap table. They can have 10, 15 funds and the bigger funding can come up, right? And this becomes a disadvantage sometimes for the angel investors. I will tell you how. Now, because 200 investors are allowed, if 1 lakh investors are coming on the cap table, suppose 150 investors come up. Now, when the VC comes, they will not be interested in having so many investors on board who are decision makers. So VCs will offer an exit, or the startup has to give a buyback exit that moment. Right? And that becomes the opportunity for the angel investors. But in case angel investors are also investing through the fund route, then VCs might not give them exits. Then angel investors who have invested through angel route might have to wait till the IPO happens, right? So that is a bigger difference, and opportunities of exits reduce, and that is the main reason we were avoiding filing a fund. But again, there are challenges coming up.
Very much clear.
Yeah, there are challenges coming up from the SEBI side. This is what I'm hearing. So sooner or later, everybody has to become a fund if they have to operate, because this way SEBI can control everything without getting the angel network into the ambit of SEBI. It is difficult for them to regulate, and they are afraid if any scammers come up, then there will be a big difficulty, because scam can come up if there is no due diligence. That changes everything. So there are platforms who are just inviting investors to invest directly. On the other side, they are just listing the startups. They are becoming like brokers. And in unlisted securities, you cannot act like a broker. If you act like a broker, disasters could come up, because in listed securities there are compliances, everything is in black and white, government structure is there. But in unlisted, there is no such structure. So some organization have to come up and do their due diligence, and this due diligence has to be in a proper organized format. If you look at the terms and conditions that we share with the founders, you will be having a fair idea, how we do. In fact, I can show you one agreement also of due diligence, which can clarify a lot of things what we are doing, and then we are following that process, right? I hope my screen is visible.
Yeah, I can see. Yeah.
Right, so I'll just jump to the important points of due diligence. That is this: we are asking for these kind of documents: original bank statement, balance sheet, trading account, profit and loss, legal notices. If any legal notice has been received, it has to be notified to us. GST statements of current and last, income tax statement, tax deposited at source, details of cases pending against the management or the company, disclosure of the founder if they have been convicted in the criminal case, summary of all liabilities and assets which are not visible in the financial statements, right? Social media account reviews, links, references of two vendors, service providers, references of buyers, customers with cell phone numbers. We actually verify the buyers and customers. references of 2 previous investors. If any startup is coming with a previous investors, we want to check what do they say about it. Then salaries of employees, salaried employees references. We want to see whether employees are happy or not, any kind of, because employees can detect if any issue is going on, right? Photographs of all the offices and physical outlets, attendance of employees. We have to find out whether the employees are actually joining the company or it is all fictitious. All the mandatory compliance and details of salaries and cash withdrawn by the founders. Moreover, we have very strict conditions of utilization of the capital with the so that is not a part of due diligence, that is a part of the mandate. We don't allow them to just take out money in cash. We don't allow them to take high salaries. Lot of things we have already put. So that layer is the most important part, because if this due diligence and the mandate is not strong, it's not watertight, then there will be a lot of problems. I'll tell you the process, how this is done. Our team study all the financial documents. Then we verify the data. Then a risk assessment team assess the risk. Then a profitability assessment is done. And then we find out first-hand reviews from employees, customers, buyers, sellers, vendors, investors, and all others, right? So that is how, and this is an actual agreement I'm showing, right? This is how we follow the process. And then there is a declaration signed by our financial analysts that I have done the due diligence to the satisfactory level. Then we start the process. One more thing I would like to tell you, which makes us different. We do the financial statements of financial projections. So there is a particular way. I have invented fair share method of valuation and financial projections. That method is utilized, which matches the exact requirements of burn. That means whatever capital you will be requiring in future is projected in the sheet itself, and we can match this. If somebody is saying I would require 4 crores, we should be having each and every minute detail of that expense. If somebody says I will be utilizing 5 lakh rupees a month for promotion, then we will be asking them the breakup, and that breakup will be visible to our financial analyst, which could be shown to the investors, right? So that is the level we are doing the due diligence and the financial preparation. We don't present many startups. We bring in one startup in a day, because we believe that investors should get the best opportunity, despite of the fact that we have the sourcing from 40 cities in India, right? Still, we are presenting very less number of startups. So I hope this satisfy the question.
Could you
That is
share
more.
some information about your company itself, your background, how big are you, and how many years in business, and that kind of stuff?
Yeah, so my educational background is I have a law degree and I have a degree in MBA, that's with specialization in finance, right? So total business experience I carry is 24 years. I started my first startup in 2001, and StartupLanes is a global angel network. We are operating in UK from our HQ is in London. We are operating in the Middle East. We are partners with His Excellency Sheikh Mansoor bin Khalifa Al Thani. They are the royal family members, and we have 50% equity sharing with the royal family of Qatar. So entire investment in the MENA region is done by the royal family of Qatar. Then in ASEAN, the 10 countries, we are operating from Pattaya through our partner, which is a leading business family there. And they already had an office in Pattaya. So instead of making Bangkok as a base, we made Pattaya as a base. And Pattaya is coming up with a new airport, with a new special economic zone. And with the local government's help, we are building up the ecosystem there. In India, we are operating in 40 cities, and we have more than 200 franchisees all across the world. So that helps us in sourcing, and that helps us in finding out better investor base. we are a full service organization. That means angel network, as well as we do complete investment banking till the IPO. So we have the service of raising funds for A series and B series startups as well. Any specific question on that, I'll be happy to answer.
Thank you.
In so detail, I have two questions. First question which I have is, what is the normal exit? So the tenure for investment, is it only we can do when the IPO is coming, or with Series A, Series B?
So we have
happening?
we have done exits in even 2 months. You can continue.
Okay, so normal the period is from 2 months to it could be a year or two.
It could be the next day of investment also.
It could be next day. Okay, so the analysis that you do, right? With that, there are a lot of companies I have been tracking that is coming from you. There have been some good, some bad. So it's a mix of hit and misses, right? So with the percentage that you see, any mutual fund when it pick companies, right? There will be 20, out of which 5, 6 would be outstanding, 8, 10 would be average, 4, 5 would be laggards. To that, when we are directly doing in a company. It's not like a pool of company where we're investing and the money is getting, uh, divided based on that. So
you are investing directly into the company, one company.
Directly into the company. So has there been a case with your analysis? There have been misses on. I just wanted to understand the risk element of it.
Yeah. So I'll tell you a case. So first of all, out of 129 investments in our portfolio, only one startup has been busted. Okay. And I will tell you, without disclosing the name right now, I will tell you what happened with the startup. So founder came with a third party due diligence to us. And that is one of the big four. So I don't want to name it on camera.
No, it's fine. Yeah.
Yeah. So that is a big four, and we relied on that due diligence report. And after funding, we found that the founder is siphoning off funds and is not utilizing the fund for business. Later, we found that they have fired the entire team. They have not even paid the salaries and provident fund. Then we found that they have not paid their vendors. So immediately we informed all the investors as the first step. Second is we collected all the investors and formed a community. Third, we discussed on the Zoom call what should be done. And one of the investor who was well connected with the police and other authorities said, I can try to put some pressure on the founder and find out. One of the investor was a lawyer, and he said, I can try to put some legal pressure. And both these things happened simultaneously. We sent our person there physically and found that the founder has 30 crore worth of property in the name of the family, father and mother. Then two policemen came, went to his house, discussed this, and the founder understood that this, because they are not, criminals. They just tried to play around. And the founder got afraid and he said, okay, I will refund everybody's money with 18% interest. And I am ready to give you checks. This is my property in North Delhi. I will sell off this property. And so that property was in the name of his mother. We said, okay, if your mother writes it, that I acknowledge that this is the problem, and I know I'm regretful of my son's doing, and I will be happy to dispose of this property and set off the dues, then it is okay. And this happened. We got a stamp paper agreement. Check has been issued, and within 2 months, this money will be utilized, realized back. So this happened. And
so you're saying none of the cases where the money from the investors got lost. This was one case where you actually had.
Yes. And I will tell you why this happens. Because we don't showcase. If you carefully investigate the opportunities shown by StartupLanes, you will find that we don't allow in the founders to invest into more of fictitious or non-tangible assets, or even asset heavy businesses. One, we choose the industries which are easily understandable and growing and are stable. We avoid deep techs, right, where investors don't understand. Sometimes our teams don't understand that it could be a chat GPT API call behind the scenes, and financial analysts might not be able to detect it. So we don't get into all that. More of, you will find the startup showcased by us are uh, easy businesses like food and beverage, cosmetics, which you can find out. And there is a particular way of finding out whether this business is growing or not. So we check through.
I got your point. Sorry to interrupt. I have one more question. So whatever and what I've seen is, the startups, whenever they go for valuation, they try to always over project the sales, the revenue, and how it is going to in the future, right? So now with the analysis that you or your team does, with the checks that you already showed us, right? How come you get to know that this is the right valuation where we need to enter? Because a lot of cases I've seen where people have entered at the wrong time, and then no more funding came, and so the valuation went down and they had to exit at a loss.
Correct. So I'll give you, there are some rule of thumbs in the market, but before that, there is a valuation method. It's a proprietary method called fair share method of valuation, developed by me, globally accepted now. Thanks to all the stakeholders who have promoted this. Even we are receiving this valuation request from big VCs, global VCs. Right? So this valuation included 26 points, and to A to Z, we find out lot of things. We find out the profitability, we find out the team, we find out the backward integration, we find out the disruption. There are 26 data points we carry, right? This is the latest method. On those basis, we find out the valuation. And a lot of people were asking us, and they were saying that valuations, if you do, it has to be in the range of what investors can calculate. So there are some rule of thumb methods which are there available in the market, which are easy methods. Like investors have been calculating the valuations of deep tech companies multiplied by 10x of the revenue. Non-tech, they have been doing like 7x of the revenue, right? We try to keep all that under 2x, 3x, which is really difficult for our team to do. But I'll give you some examples. Burger Singh came to us at a revenue of 85 crores annual, and we invested in them at a valuation of 150 crores, which is less than 2x. Zapfresh came to us at a 72 crore revenue. We invested at a valuation of 150 crores, which is again near to 2x, right? And many such startups we have invested. Only in case of a startup which is very early, which does not have much revenue, that time they might get a valuation of around 10 crores or 12 crores or 15 crores, because that time a different method applies, which is called David Burkus method, which is developed by an international association with, through Sir David Burkus. And that method has 5 divisions. They give $0.5 million maximum valuation to 1 point. First point says the idea, second is the market size, third is the competition, fourth is the product, fifth is the revenue. So if the analyst is satisfied with all these 5 points, and if all 5 points exist, then the analyst gives out of $0.5 million valuation, right? So this is the way they get around 10 crore, 12 crore valuations, but not maximum a startup can get is 2.5 million. Right?
Okay. Thanks a lot for answering the question. Just last question I have. Okay, you have answered most of the questions. So the risk factor and the valuation you are taking care. So that's something that you do due diligence first, and then you think it is something which is worth investing, and then you convey to your customers.
Right.
Okay. The exit can happen anytime, as you told. It is something that is on that is something you decide, right? And you tell the investors.
No. So we don't decide these exits. Exits could be of three types.
Okay.
Exit on further round of funding, right? So
Okay.
it could be like, suppose you invested in a startup at a valuation of 20 crores.
Yeah, I got it. 1.5x, 2x, whatever happens, you
Yeah.
tell
So next
people
round
that
may be
if
happening
they
at
want.
40 crores. So startup can offer you buyback, or the incoming investor can offer you a sale.
Yeah.
Right.
Okay.
Second exit is through an acquisition. That moment, you founders will call you and say that, we are getting acquired, sell back the equity to us. Third is the most common way, which is through VC funding or IPO. Right. So these three exits could happen.
Now in case of third part, IPO is something that has to come from SEBI, and
Yeah. So
market
there is
approval
a
has to
fourth
be in
case
place.
also, which I was about to tell you. So in one investor invested into StartupLanes, and this is about my company. They invested into StartupLanes directly, and mishappening happened into his family. Somebody's earning member's death happened, and he said, anytime this exit cannot happen, can you give my money back through some way? So we transferred this equity to another incoming investor who wanted to purchase the equity, right? So this transfer happened, and this has happened without any profit margin or any kind of brokerage expectation. This happened because this was.
So anytime an investor needs the money back, we are trying to see if there is some investor
sell off this
who can
equity
pitch in
to anybody else.
Okay, so just for the third point, where you told that when the IPO comes, IPO takes a lot of time, right? Company has to exist for some time. It has to show consistent revenue and things like that. Then only the IPO will come. So that tenure may be 5, 7, or 10 years in a lot of cases, right? Whether it is Paytm, Nykaa, you see, they have operated for a period of time, and that is when they got listed. Now, for that to happen, in that case, we have to hold on for 5, 7 years, or will we get some exit option in between as well?
Yeah, that is what I was about to tell you. If we are loading lot of investors in the directly captable, then sooner or later they have to give exit to the investor, right? Because they will not be able to raise funds further, and VCs will not allow them to have so many angel investors, because so many decision makers, it's very difficult going further, right? So they generally give exits to the angel investors that particular time, and this is how angel investors exit. But in a fund, like I told you, it becomes sometimes difficult, because now it is not hampering anybody's investment, so they might continue with the fund. So fund investment has this kind of challenge. Another point that I would like to clarify is, like, SME IPO is a different ball game, which is different from the main board IPO. And SME IPO is very easy, which can come anytime. Only three conditions are required.
Yeah.
Minimum 3 years of completion from the registration of company. Second, 1 year of profit in the last 3 years, only 1 year. And third, 1 crore assets. That's it. So any company can file for SME IPO, and generally there is a rule of 21 which is applied. So 21x of the EBITDA can be the valuation at the time of SME IPO. Even more than that.
Okay, and the fees that we have to, which is charged by StartupLanes, is only when we do the exit. So that is where you charge a management fees of 10 to 15% at the time of exit, right?
We don't charge investors. No membership fee, no kind of brokerage or service fee, and no carry at all. Right now, we are not charging anything, and we have never charged any of our investors for anything. But in case we get a SEBI regulation that we have to convert to a fund mandatorily, then we have to follow, because there is a cost. There is a compliance cost that has to be loaded to the investors. Right? That time we might have to charge just like others. they are charging 2% of the investment as a compliance and operations fee, and 15 to
In the
20%
PMS.
carry.
Oh, in the
So
PMS
how do you
space,
make
they're
your
doing-
money then? You charge the companies
Startups.
themselves?
Yeah, we
Okay.
charge the startups.
And what percent?
2% to 4%.
Okay, thanks.
All right. So yeah, Anshu, you have a question?
Yeah, I just have one small doubt. Do you also help in liquidating? So let's take I have invested in few companies in the early stage, and for say like Biryani Bay Kilo and Egos, and there are a few more who are doing pretty well in the market. So do you also help in liquidations, or can you help me find
Yeah, we
buyers, or
can
how do you
do
do
that.
that, or you just
We
Yeah.
can do that subject to due diligence of the startup,
Okay.
and we have to take that startup for further round of funding. If we find that it is suitable for our investors further, but right now we are not able to shift the equities of existing investors who have not invested through SL platform, because we don't know what kind of startup, what is the due diligence. So we have to follow that DD process. Then we have to do the financial projections and find out the profitability and
Got it.
expectations.
So you are mostly into primaries then. You don't facilitate
We are
secondaries.
not acting
right?
like brokers at all. We only work in value add, and we are bringing in very less number of startups. It's not like too many startups. We do exclusive demo days. Only one startup comes in a demo day, and well preparation. Lot of documents are in between, which we do, like from due diligence. We do pitch deck, valuation, projection, research report. Exit sheet for the founders is the latest document that we have started preparing. This is also unique to us. Using this document, you can find out, as per the statistics, a mathematical calculation, how much money you can make from this startup after a particular period of time. You can put in 1 month, 1 year, 5 years in the sheet, and sheet will show you what will be the exit amount that particular moment.
Got it. Thanks.
Yeah. So we have Savio. Savio, can we take your question?
Yeah, can you hear me, Shishir?
Yes.
Okay. So I am from the manufacturing field, industrial product manufacturing, and I've been looking at companies in that particular field to invest in. Now, you mentioned some multipliers on the revenue numbers, 2x, for example. Does that apply to manufacturing industries too, or is there a different standard?
So every industry and the type of startup business model has a multiplier. This is the multiplier which is given by the investors in the industry, right? So this is not made by us. This is just a rule of thumb kind of method, which is to simplify, but it is not the right way to evaluate a startup. We have a very extensive, detailed method of evaluating. But yes, if you are, say, investing into a snack manufacturing startup, then investors would prefer keeping it to maximum 4x, looking at this particular period of time. Time is very much important factor here. So right now the industry is difficult, the liquidity is less. If you go back to the pandemic, edtech were getting multiple of 7x, 10x, 20x, 50x. Now nobody is happy to invest by more than 2x in edtech. So this depends from time to time upon the demand and supply numbers and expectations of the trend. Like edtech trend was there that everything will be online later on, but now edtech is going back to physical. So even big companies are changing their model back to physical.
Thank you so much. Just one more add-on question.
Sure.
Have you invested in industrial manufacturing companies at all? And if yes, what was your experience?
Earlier, till last week, we were not investing in any asset-heavy company. The reason behind was it becomes very, very difficult to scale up. If you are investing, say, 1 crore in your factory, you can utilize this 1 crore in digital marketing and get more. So I was about to tell, I got another question that time. So how do we evaluate it? I'm just giving you one of the methods. There are so many KPIs that we see. I'm just giving you one KPI, which is CAC is to LTV and CAC is to immediate revenue. Customer acquisition cost is to immediate revenue. Now, this number we have decided as 1:16. If you are acquiring a customer in say 1 rupee, then that customer should give you minimum 16 rupee in terms of revenue immediately, right? So this solves all the liquidity problem. This solves all the problem of growth. And we have found that if this is happening, then they are tend to perform good. If this number is far better, there are startups which has 1:2, like we have invested into a startup called Hobbit. They have grown 4800 4800% in last 1 year, right? 4800%. And the reason is they have everything digital. They record a course once and the camera has AI. So suppose guitar playing is there, the camera, your system will tell you that you are playing the guitar wrong. This is the wrong move. You can correct. And so this IP can be utilized many times. So their CAC is very less, customer acquisition cost, but their immediate revenue and the lifetime value is both high. Because somebody who is taking a cooking course, maybe taking guitar course, maybe taking some other courses, and this goes on and on. So we check this as a primary thing. Second is the utilization of fund. Internally at StartupLanes, we have created, and all our teams are informed to mandatorily check 85-15 rule. 85% of the funding should mandatorily go to customer acquisition. There are certain exemptions, or there are certain out of the rule book situations also. Like one exception is wherein a business model is, a startup is coming up wherein they don't have any digital marketing. They are buying electrical products and selling those electrical products to a distributor who pays them entire cash. So in one go, the distributor is paying them cash, and then they are paying to the manufacturer. This is 100% asset light model, no customer acquisition cost at all. Right? Distributor is then appointing retailers and marketing later. So this way, this could become an exception wherein 100% can go into the product, but otherwise we were avoiding. Now, just last week we created another model of 40% 2 years. So we studied the market and found that founders are taking unsecured loans at 2%, 3% per month, and that is like very difficult to secure. They are taking loan from banks at 18%, 20%, wherein the risk element is high for the bank. So we created this model wherein they can have equity. Investors get equity on the other hand. Their valuations get established. They can raise funds further. This does not hamper their CIBIL score. They don't have to provide any collateral. And still the investors have a collateral and a compulsory buyback, so that investors can also do their maths. So now we will be having a lot of manufacturing companies coming up. But right now we are trying to take only manufacturing companies that has a revenue of above 10 lakh a month, and they must have completed at least 6 months stable revenue or upward trend of the revenue. So that will be coming up soon. We have 3 startups in the pipeline. One is supplying, one is into pharma, so they are the vendors for big pharma companies. Another is into events. They are the vendors for big corporates for MICE. And third one, I have limited information right now. So that will also come up in a day or two. Yeah, we can take.
It is into hospital equipments.
Oh yeah, hospital equipment. Okay. So these 3 are there in the pipeline. Good revenue startups. And Savvy, you have another question?
No, I don't. Thank you so much.
Thank you. So can we take the question from Ajay Agarwal ji?
Hello, can you hear me?
Yeah.
Just wanted to ask you, if we want to start a startup, what is better, an LLP or a company?
Only private limited company.
Not an LLP.
No, not at all. LLP cannot issue shares.
Okay.
And you can connect with our team. We have the lowest amount in company registration, 8,999.
All right. And once you are in company, do you also help with registering with the startup initiative of the government?
Governance.
Yeah, the government has some startup initiative.
Yeah, definitely. Yes. That 20 lakh grant is there. So our team, we have vendors behind, so we don't deliver anything directly. So we have vendors, we have sourced a lot of vendors who help you in preparing all the documents and applying to the government grant. 20 lakh plus 30 lakh is there. 20 lakh is the grant. 30 lakh is the convertible debenture.
All right. Thanks, Shishir.
Yeah. Teja, can we take your question?
Hey, hi, Shishir. Yeah, I'm new to investment in this segment. Haven't invested before, but I'm curious. So, have some basic questions to understand, right? Do we get any collateral for these kind of investments?
Yeah, you get equity. That is your ownership in the company.
Agreed, but equity is virtual, right? Do we have it backed by any of the assets, illiquid or liquid assets?
No, equity is your legal ownership right. Right? If the company has say 1 crore, I'm just trying to simplify. Okay. And there are 100 investors. Everybody has 1%. That means by 1%, it is you are owner. You are legal, legitimate owner. Nobody can take this from you. So 1 lakh rupees is yours in the company. Right? In terms of your percentage, you own the company. And in case they dilute, right, then they have to pay back according to the precedence ratio. First, they will be paying to their debtors, that is generally, the loans and all the banks, and then they will be repaying the equity.
Okay. So, do you also deal with, is your company also dealing with investments where those are asset backed investments?
Yeah. So we have asset financing opportunities also. Like you buy your car, right? You buy your car, a commercial car, and give it to our startup called Taxida. On the amount, there will be some charges for the legal arrangements and all, like 20,000, 30,000. Then they will be starting to pay you 4% of the car's cost every month. Car will be in your name, and they will be just taking that car on lease from you, and they will pay you 4%. That car has to be in Chennai or Goa, because these two areas they are focusing right now. Later they will be coming. They have tied up with Make My Trip, Ease My Trip, lot of companies. But right now the service area is Chennai. So in case you do not have your address in Chennai, then they will give you a rent agreement kind of arrangement. But that is something you should discuss one-on-one. But there are opportunities like these, wherein you can invest into asset directly.
Okay. So, would be interested in asset-backed investments. So, we can connect off separately, probably with your team or something.
Definitely, yeah.
And there are two more questions that I have. Let's say in the startup, who is going to monitor that startup is doing fine after investment? Usually what happens is, in a typical world, you invest, and in fact, the kind of investments that probably from StartupLanes, right? It's to the tune of, it's not like a VC, right? Where you have complete control on the board, where you manage the decisions of the founders, right? So you have large stake where in every decision making. Here, you're investing, and we should be running to the tunes of the founders, right? Like, so how will we control our investment, and as in specifically, to ensure the safety and security of like the investment that we are making?
So we the first thing we do is we sign up a mandate, an agreement with them. They cannot use this money to buy car, vehicle, or their personal travel. They cannot take out cash. They cannot pay heavy salaries. All those things are already taken care of, right? Then, if a normal course of business is followed, I don't think so anybody can take out money anyway. Then there is an audit. Also, every month, we can organize, and we are organizing this when the investors ask for it, a monthly meeting with the founders, right? So in that meeting, you can ask all the questions, take the updates. The most important part is, unlike fund, you have the direct control. You have equity share, right? We don't do CCDs. We don't do SAFE, right? So these are all USPs of StartupLanes. We don't do SAFE. SAFE will not give you any kind of equity in hand. This is all just imaginary, right? Again, I'm not against any of the models, but we don't do. And you will get complete proper ownership of whatever amount you are investing, and direct ownership recognized by law, followed under the Companies Act Section 42. Everything will be black and white. There are multiple methods of complaining. You can complain to Ministry of Corporate Affairs, you can complain to SEBI, you can complain to RBI. In case any kind of discrepancy is there, your control is 100% there. If it is a fund, you cannot complain, fund can complain, right? Fund, so because there are so many investors, it becomes very, very difficult for the founders to do anything which is not required, right? But in a case of fund, this could be done. But in case there are so many investors directly invested, it's very difficult to do anything, because somebody or else will find out, and they will show you all the financial documents. You have the entire right, you have the voting right. It's not easy. That is the reason, out of 129 investments, only one startup got busted, right? We choose the industry well. We find out. We don't take anybody who says, I have taken money in cash, my sale is happening in cash. We don't take them at all, right? We just find out 100% bank transaction deals. If any organization is dealing in cash, we ask them to deposit the money in the bank within 24 hours, so that it is good for them. It will save them from any kind of tax issues later, and their valuation will keep on rising if they bank everything, right? So we don't allow any kind of issues, but yes, risk is always there. Risk has to be there, but it's not like that they will do whatever they want. They cannot. We put in all those terms and conditions, and finally there is an option to buy back. If they are not giving you opportunity to exit, then they have to buy back the equity.
Okay.
Yeah.
Other part that I had is, like, out of these 129 startups, how many startups we got exit so far?
So there has been couple of exits, around 7. We started in mid-pandemic, wherein when pandemic came, we were in a physical model. So we were like last 2020 also, we did an event in Bangalore on 29th of February. That was our last event, which was physical event. Earlier, we used to invite investors in a physical event and startups in a physical event. That is how it used to be there. But that model was not very successful. We realized our mistake that it's not easy to fund a startup in a spontaneous mode. We do a lot of preparation, and it goes 2 months of approximately work in the background. Then a startup is presented. So it has been almost 14, 15 months in which we have done these investments. 7 exits, odd exits have come up. More are under
What is
5 lakh.
the min exit value and max exit value that we got in these 7?
So in terms of, you are asking about the profitability?
Returns. Yeah, profitability. The returns.
So I'll tell you about a startup called Experiential ETC that came into Shark Tank also. Right. So within a span of 6 months, they offered 50% ROI. That means those who have invested 1 lakh, they have got 1.5 lakh. And this is a straight buyback by the startup, because they were going for the next round of funding. In another startup called, I do not remember the name exactly. It was Sanjana. What is the name of that startup of Shauna? Talent Gum. Yeah. So in Talent Gum, this 50% ROI came in 2 months.
Okay. What was the minimum exit like that can be guaranteed or something? Is there anything of that sort?
Minimum exit that can be guaranteed is 24% in the first model. I'm repeating, we have 2 models now. We just changed everything. So 24% is the optional buyback. In case the startup is not growing, investors have the right to force this buyback. Founders don't have. Okay. And the other model is 40% compulsory buyback. Nobody has right. It is compulsory to give back the equity because they are giving you the checks in advance. So you cannot say that I want to hold the equity. They cannot say that we want you to still stay invested. This transaction has to be necessarily completed. In case you want to reinvest, that is your choice. You can again come back, but 2 years. Now, one thing which is very important, why 2 years? Because there is a law in India which says listed securities, if you invest, long-term capital gain is 10% and 1 year, right? It has to complete 1 year. Unlisted securities, long-term capital gain is 2 years and 20% tax you have to pay. So both sides, it has to be listed. If you convert it, if you have to get the benefit of listed security STT paid, but that is not the case in the unlisted one. So in this case, if you are investing, say 10 lakh rupees and 40% 2 years guaranteed you get. So on this 4 lakh rupees after indexation. So there is a inflation index which government provides. So after indexation, whatever earning is coming. So out of this 4 lakh, say 50,000 or 10,000, whatever, let's take example 50,000 to simplify, is deducted. You have to pay tax on 33 lakh 50,000 and 20% of 3 lakh 50,000 is like 70,000 you have to pay. That will be your long-term capital gain. Right? So that will save you from the highest tax slab. That will give you the indexation benefit. And there are certain other benefits in long-term capital gain. If you reinvest the money in XYZ, there are models, then you don't have to pay any tax.
Okay. So what I'm hearing is, there's 20% and 24% short-term and
24 and 40. 24% in 2 years and 40% in 2 years. Generally, for fast-growing companies, we are doing this 24% agreement with them. Right? This is not the choice of investors. It is like we are doing this agreement and we will tell you that this is 24% optional buyback opportunity. Other one, we will tell you that this is a forced buyback opportunity. So fixed asset companies where we don't expect, very fast, massive growth, there we will have these second one, so that the capital is protected. So one gives you faster growth, another gives you capital protection more.
Understood. Okay.
Yeah. And we have questions from Ankit Ashok ji.
Yeah. Hi, Shishir ji. So, Shishir ji, I have just one question, 2 questions basically. So, in continuation with the question from Pija itself, after the funds are put in, don't we have any mechanism to monitor, let's say, some quarterly reports or something?
Monthly,
wherein the highlight.
So, at the end of the month, or quarterly, depending upon how investors are asking. This could be done monthly, this could be done quarterly, right? So we did monthly also, but many investors were not coming. So we did quarterly, and in some cases, investors are not even interested for quarterly, right? So this depends. If you want, our team will organize monthly. If you want, 2 times in a month, our team will not be denying it. We will do it.
Or just wanted to understand, do we have a right? So I'm a CA by profession, so just wanted to understand. So do we have a right to check the financial statements also in case, let's say, to understand or to have a comfort on the proper utilizations of funds?
Yes,
That
sir.
was
Definitely. This is put in the agreement, so we are taking those rights and asking the founders to sign it. And because it is an equity share, you get all those rights which come with the equity share.
okay. Understood. And second thing, at the time of investment, so before, would you be presenting us with the stats and your research report also, that this is the company and that's how we are going to progress?
Yeah. First of all, we give you a research report. Just like you get a report in the mutual fund, we give you a research report. Then we give you the presentation in the pitch deck. In the demo day, we will show you the pitch deck. We will show you the valuation. Our analyst will explain you why this valuation has come up. Then we will show you the projection. Our analyst will explain you the projection. Right? We try to prepare all these documents through our teams only. Sometimes the founders say, no, I have already raised funds and these documents are already validated. That moment, it's not possible, to go and do the again document. But 90% cases you will find all the documents are done by us, and our teams will be able to explain you each and everything in terms of financials.
Okay, understood. And do you also support any? So let's say your team being the facilitator, do you organize or do you have checks with the startup in which we are investing, like doing a quarterly audit or a half yearly audit on your own to have a comfort and being a responsibility towards the stakeholders as well?
Yeah, sir, you joined a bit late. I've even showed the entire process, what all documents we asked in the same meeting.
No, I've seen that. So I've seen that. No, so that was at the inception stage. Once the investments are done in the startup, post the investment,
No.
do any? Okay.
Sorry to interrupt, but we do it. We do the DD. This is a differentiator. All the companies except us, they do the DD when the commitment is confirmed, because they hit and try the commitment. They showcase 5-6 startups, 3 startups in one go. We don't do that. We only bring one startup and everything will be ready before that. We do the DD before even taking the startup.
So after the amount is invested, then there is being the facilitator, then there is a no such due diligence happens post the investment.
100% not required. At the time of investment, only allotment is required. Rest everything we take care before presenting to the investors.
Got it. Understood. Thank you so much.
All right. So can we take question from Niranjan ji?
Hi, Shishir ji.
Hello.
Hi.
Yeah, Naresh sir, after that, please.
Yeah.
May I question now?
Sir, after Niranjan ji, please.
Okay.
Yeah.
Can I proceed?
Yeah, please.
So I have only one question. Typically, what is your area of investing? Only at seed levels, or you are looking at even higher rounds? Because a startup needs multiple times of investments, right? So, and the valuations also varies in between these rounds. So how do you target, and then how do we, that percentage of equity allocation, how it goes?
You're asking me about the segments where we prefer to invest?
And the type of, how you come back with the equity distribution at the time of investing, and passing on to the investors at the end of the day. Right?
Yeah, that is as per 100% as per the valuation and the amount. Suppose the company is valued at 10 crores and you are investing, say, 1 crore, so you get 10%. Right? If you are investing for 1%, then you will invest 10 lakhs.
The question is how we are coming up the number 10 crores.
Through the valuation. This valuation is done before presenting it to you, and we will explain why this valuation has been done.
So this happens at every investment round.
Every time a startup is presented, we will do the valuation, financial projections, research report, due diligence, and now we are coming up with another document called exit sheet, wherein investors can see on the basis of mathematical projections how much I can earn after a particular time. So this is a variable sheet we will give you. You can make the changes yourself and find out. But this is specific to a particular startup. This sheet is not universal. It will be applicable to that startup only.
And you mentioned like two types of variant investment modes. One is towards the longevity and capital gain, and another is, I think, capital protection, like 24 within both are aimed at 2 years of time span.
Yeah, both
but various returns of 40% and 24%.
Both will be long term.
Both will be long term. But you mentioned some of the exits much before than that. So the founders has this right to exit before the time itself, or how is it?
Yeah, so if you are getting 50% exit or 60%, 100% exit, that means 2x of what you have invested, or 50% of what you have invested, then you can exit that time and you can pay the short-term capital gains. That is added to your income. Normal slabs apply.
I mean, is it like acceptable if it surpasses this minimum commitment of?
Yeah, see, if it is, obviously, if their offer is there and you are exercising that offer, suppose another investor comes up and asks the startup to first buy back the share if they want to invest directly into the startup. Then they will offer you that you have invested, say, 1 lakh and they want to buy it for 1.5 lakh. You okay it, accept it. Then your shares are given back, your money comes to your bank account. And
yeah, that's all. Those are the two questions. Thank you.
Anybody else has a question?
I Shishir Gira this side. I dropped 2 questions in the chat. If you can please help me to answer that.
One moment. I want to ask, a SEBI guideline needs to be followed going forward. This is something that can't be avoided, which means StartupLane must follow the same. And how this is going to impact existing investors of StartupLane? That valuation formula. Okay. So you are asking about the SEBI guidelines and the StartupLane must follow the same. How I want to ask you, mention about the valuation formula. What about startups which are yet to be start operations and have raised a decent amount of money? That is MobiPay. Yeah. So, second round of MobiPay that they did was, is directly they have approached the investors. I'm sure you already know that this was not organized by StartupLanes. So we have not done any kind of valuation there, no projection, nothing, no due diligence has been done, right? Because you were the existing investor, they have the right and you have the right to transact, right? So, but this was not through StartupLanes. Has it been, it will be officially announced. We will do all the documents, research report, and then present. If we do the second round also, we do the entire process. Second, about the SEBI. So, there is no particular enforcement of SEBI as of now, but this is what I'm hearing, that all the angel networks might have to jump onto a SEBI regulated fund. So we are also filing for a SEBI regulated fund, but we will continue to have angel investment directly on the cap table till the time SEBI does not have any problem, right? The moment we receive any kind of notification that now you have to convert to a fund, then we will have to, and the time will be given. Ultimately, private placement route, not going through a fund, is not at all illegal or any issue is there. It is just SEBI wants to regulate, and that fund is there and the cap table, number of investors. But definitely this gives you more control, better opportunity to exit, and this is the best method right now. If we might also file for the fund, but not at all right now, because there is no instruction. It is all rumors that I'm hearing. and a lot of people, a lot of other organizations like us, they have created their fund, which is good for them, but we have not yet even applied for the fund. So this could continue. And the reason is we want to give more control to the investors, more options to exit. We don't want to put load on the investors. And I think this is better. But in case investors also want to go through the fund, then we will definitely. And it does not affect any of the existing investments. There is nothing like this could be shifted to a fund. So that's not the case. All the investments that you have already done, your name is there in the cap table.
Understood. So on the MobiPay side, right? I was just using MobiPay as an example, right? There's so many startups, right, where we paid the funds, right? And I can say it's been 3+ months or some are in 6 months, right? They're not even started the operation. So is there any pressure from your side also, or is there any deadline received from the founders? Okay, when they're going to start the operation, because the sort of money they raise money to run the startup, right? But still they are raising, but they are not starting any operation. So I just want to have the clarity how the actual process works.
See, so in case a founder does not start the operation and the money is lying in the account, we can definitely put an investor meeting and ask them why it is happening. In case they are using it for personal paying salaries and all, then we can create an objection, and obviously as per our mandate it is not allowed, right? So then we can take a legal action as well. So both the opportunities are there. And one more thing which internally we are trying to come up is we're trying to come up with a capital protection methodology, wherein in case, God forbid, if any startup is busted or any startup has issues of founders willfully doing bad things, then we want to create a fund for legal fight. So we are coming up with that particular formula. Maybe we will optionally put 1% of the investment to the investors optionally if they want to get into this, so that at the time, if any of the startup has this kind of issue, we can use this money on behalf of the investor to fight a legal battle. And out of 100 cases, if one happens, we can utilize this entire fund for that one particular startup. So this is coming up. Maybe we are just trying to find out any regulatory issues are there. If not, then this will come up definitely.
That is really awesome initiative. And now I don't have any question. I just want to share my personal experience as an angel investor with your permission, if you allow.
Yes, sir. Please go ahead.
Yeah. So like in this call was really awesome, first of all, and thanks for the wonderful audience and for your patience to answering all these questions. And during this entire conversation, right, you mentioned so many exits happen in a couple of months, days, the year, right? And I'm sharing my personal journey, right? Because I think it's been almost 8+ years investing. And in the career point of view, it's been 15+ year in the business supply chain operation. And out of this 10+ year in the startup only. Why I'm mentioning all this data point to you so that you can understand what I'm trying to portray, right? When you starting your journey, because I'm sure that some of the people here on this call are the new investor, and we as an investor sometimes only want to hear what look good in our mind, right? So okay, if I'm investing 1 lakh, it will become 2 lakhs in 1 year. It's good, it's happened. It's not like never happened, right? But I will share my personal story, right? When I initially started working in the startup, and most of the startup, just to attract the good talent pool, they also give you chance to participate in the e-shops, right? And they will issue some sort of e-shop based on performance. Even if you're just taking example of e-shop, right? I'm not investing any money in the company. I'm investing my time and the talent, right? And once you keep working in the company for a couple of years, right, then you get a chance to liquidate and get the value out of it. And that time generally vary between 3+ year to 4 years, 5 years, different company to company. Why am I mentioning that? Because when you are joining the company, they give you shop from day first, some X value. But you're not going to find you're going to get that value double, triple within the time of 6 months to 1 year. Generally, you have to work in the company for at least 3 years, 4 years, 5 years, subject to your seniority in the company, and then you get a chance to get the value out of it. So technically, company is appreciating your efforts, time, what you are investing in the company to take company to next level. Now, if we just replace this example with the current investing, right? And I personally, as an investor, right, when I invest in the company, I'm not a CA, I'm not a financial background, no lawyer, nothing. I try to understand the startup from the user experience. If something making sense for me as a customer, can I as a customer use that product or the service? If my answer is yes, I invest blindly. Very simple, right? And obviously, we'll keep monitoring their what to say performance and how their growths are happening. And if I get a further chance to invest in that company, I do. But I generally don't invest in any company who can make my money double in 3 years, 5 years. Because frankly speaking, if my $5,000 become $10,000 in a 5 year, it can give me joy, but it's not going to add any significant value in my lifestyle, right? The only significant value can be happen me when my 1 crore become 50 crores, right? Or my 1 lakh become 50 lakhs. That is something significant money, which giving me sort of a pool, which I can reinvest and keep generating. So it's a journey of become a wealthy, slowly, overnight. I don't believe to become a wealthy, and I'm suggesting from my personal experience of last 10 years in investing, right? Please don't fall in this sort of, I'm sorry to use that word, scam, right? Because you're not going to get opportunity to getting money double every 2 months, 3 months, 6 months. With all due respect, if anybody feel this bad, I'm sorry for that, but that is something my personal experience I want to share with everyone.
No, absolutely correct, Girirajji. I 100% agree with you. It's not, if you have this expectation of getting the money double in 2 months, that is a vague expectation, and that kind of opportunity is my bust off. It's good if you have a 5 years perspective. Definitely, the money grows, and entirely, no matter how good due diligence you do, it depends entirely upon how well the founders execute and how well the industry is performing, right? So no matter edtech founders do whatever they can, and if they are just into online mode, their CAC is increasing drastically, and revenue is decreasing, right? So they cannot do anything. It's beyond the control, and if they don't have models to pivot, like it has happened with us also. Like I told you in StartupLanes, pandemic came, we were clueless what to do. We were doing physical events, and that is how everything was happening. I was not aware about Zoom. One of our regional directors told me about Zoom, and then I saw the Zoom happening, and then we thought that probably we can pivot everything to Zoom, and this worked. But maybe a case this we got lucky. Not everybody gets lucky. It could be like 5 times, 6 times you have to try. So it is also on the capabilities of the founders to treat the failure. If they are good in treating the failure, then yes, they can definitely adopt the market and perform nicely. But there are certain founders who just give up, and we have some kind of psychometric test also that we follow to find out that vision of the founder. But again, there's no 100% appropriate formula to find out the future, right? So we can just try to be as close as possible, but not perfect. Thank you so much. Anybody else has a question? I'll be still be happy to answer that.
Hello.
Yeah.
Can you hear me now?
Definitely.
Yeah. Okay. I'm Dr. Kiran. We have formed a group of doctors now who want to invest. Just one follow-up question to what you were discussing. Suppose founder wants to pivot. I have a manufacturing unit, and I know a lot of founders who took a lot of funding. The moment they feel that bhai, this is not working, or if they find something more attractive, they immediately think of jumping into that. So as an investor, what the power we have to stop them, or at least role we have in that?
See, like in the SHAs, you can definitely mention all those points beforehand, that in case such kind of decision has to be taken, investors can have the veto power in this, right? While you are giving money, founders can accept most of your points, but later on, once it is transferred, they might not, right? And this is how life works. So
I'm sorry to put a tough. I don't know whether see. My friends are also they are getting funds. So what they do is they keep the fund here and then develop something here, and they think, "Ki, bhai, I can earn more." Immediately they'll start a new company in somebody else's name, relatives, and they slowly transfer the technology to that company, and that company again they go back and take investors' money again. And I know 2 or 3 people who have been repeating this for the past 3 years. On paper, they just own one company, but all the relatives they have own company and they've taken investors' money a lot. So how to prevent this?
We
But this is
have
one
this.
thing.
Yeah, we have
Maybe
this
it's a
clause
very
in our mandate.
yeah. They won't open a company.
They cannot open another company which competes with them, and they cannot do this through their relatives. They cannot do this through any of their friends. So that is something which is we have a big mandate. I'll show the screen as well. Just take 1 more minute, and it's a big mandate. I cannot make you see everything, but I can show you the screen. So it's a huge, massive, which lot of terms and conditions, lot of disclosures, confidentialities, exclusivities, decision makings, and this says no overriding contract. They cannot override this contract above our contract. Then exits of the investors. What I was telling you.
Yeah.
This clause is already there, right? Only part is that we were not disclosing this clause to the investors early, but now we are disclosing it. So we have signed already. We have protected the investors beforehand. Buyback, you can see, in case the investor do not get an exit with 25%, 2 years mentioned in clause 17, then they have to buy back mandatorily. Then failure to buy back shares. If they fail to buy back within 90 days, it becomes their personal liability, right? So there are certain rights which are given to the startup, then responsibilities, so all these responsibilities are there. Verification, information. So it's a big
I got your point.
One thing I would like to show you, understand this section tackles with challenging circumstances. In case the revenue is falling, we call it a critical alert. They have to inform us and the investors, right? Profitability falling, we call it a critical alert. Staff leaving, in case 25% of the staff leaves, we call it a critical alert. Founder is exiting, we call it a critical alert. Any death or disability of the founder, we call it a critical alert. So then in case of critical alert, what has to be done? A committee comprising of all the investors who participated in the funding round shall be formed, along with personnel nominated by the management of SL. From our side, there will be a personnel and all the investors. Then committee will advise what should be done afterward. Then how to tackle the shutdown. So this is what your point was. In case the founder shut down the existing company and create another company, or they have more than 10% equity in a new company, then they cannot do this. Purchase rights. All the existing investors will have the purchase rights in the new company also at the same 10 rupees,
Okay, 10 value, face value.
Yeah, face value. So all those things we have already, but this is something which we were not disclosing to the investors earlier, but now the market is bad, so we are disclosing. The same agreement has been done already, previous investments also, So
okay, so we have already all the loopholes covered, I know.
Yeah. So
okay, good. You will be handling all this. See, as an investor, everybody is busy in their own fields. Like they have their own businesses and they're busy in that. So SL will be handling all this features.
We have the very strong mandate and we always take the feedback of investors. Anything comes up, we inculcate that into the mandate, and these terms can be enforced into the shareholders agreement, so that you also have a direct one-to-one terms and conditions with the founders.
Okay, thank you. Thank you for this. It's a good description. Maybe see, this is the one of the biggest point I saw. What about use case scenario? Like we put money in a startup medical device. So he developed the technology. Then he realized by this one has a very potential in some other fields, like warehousing and that. So he slowly shifted all the. He started with this, but we are still stuck with the medical device startup. But he has already started a new device, and he says like this is not a medical related field, but that one he has started generating a lot of income. So he's putting a little bit of money in this also, but the income generation is there. But what he developed, he used our money to develop the technology. How can you stop him from going into the other field? Well,
So one more thing I can tell you, I cannot stop him, but we cannot stop him. But at StartupLanes, we don't.
We feel bad. Our investment he's giving return to our investment is okay. That's fine. But you feel bad now when he's earning 10x there and he's giving 2 or 3x here, because he had used our money to develop this patent. He had filed one patent with this company also, but he has moved forward. So that's what we feel bad. Mainly, I joined this how to prevent this if we go through you.
So we don't give money for making the product. This is already a no. We don't pay them to buy machinery. We don't fund them to.
No, just the software. It's not,
not even
hardware they procure with somebody else.
Not even software. We always take when the product is ready and they are getting revenue for that particular product. So we don't take. So all these things, see what happens is being a lawyer.
And maybe I think it is a meeting. A lot of people are there. I think others might need to ask questions. Actually, I'll follow it up. I'll send you an email so we can follow
it. And it's a very good and common question which is there for everybody.
For the first time, or we have just invented once or twice, like a friend's company, friend started, so we invested in that. So a lot of people we want as a group to jump into attached to a VC firm where we can be in a better place where we can safeguard our rights also.
And to protect the credibility of people like you, we have created a method called syndicate, wherein people who have a group of investors, we make them the syndicate lead, and we train them specifically one-on-one, and provide them access to our investment bankers, so that any such question comes up, any such suggestion comes up, you can immediately tell us, and we can sort that query, and then you can communicate this to your group. And this is also financially rewarding because you are bringing in a group, so that we can talk offline. We have a financially rewarding method.
Okay, Chali, thank you. That's very informative. We'll follow it up with a mail. So I think the rest of can speak now.
So I think we are done with the questions. Still, anybody else?
Hi. So this is Ashok.
Ashok.
Hello.
Please go
ahead. So do you have the list of all the previous startups, say 129 startups list, and then also what is that minimum investment in each startup?
Yeah, so that list is there at StartupLanes website in the portfolio. The site is being redesigned, but it's already there. So, we might have some logos and everything attached to it, and we may have a particular page coming for that startup. Right now, it's only the names, but the work is going on. So we are making dedicated pages for all these startups.
What is the minimum investment in each startup?
In idea stage, we have 50,000. In revenue stage, 1 lakh rupees. But again, in certain startups, you will see that minimum becomes 2.5, sometimes 5 lakhs. Depending upon, in certain cases, it becomes 20 lakh also. Like in Burger Singh, it was 20 lakhs. So depends upon how many investors are existing on the cap table. We have to match that number. Only 200 investors are allowed. We have to make sure that this balance is capped, and you can flexibly have this. This is well mentioned at the time of inviting the investors to the demo day, we mentioned this, that this is the minimum investment.
No, not per investor, total. From suppose startup lane is investing some X startup, like what is that minimum capital you put in the startup?
As a whole, there's no minimum, but yes, it has to be, worth our efforts. If the startup is coming to raise less than say 25 lakhs, then it is not even worth our efforts, because the work is same, everything. It does not cover up our fees also. The minimum 25 lakh has to be there, minimum. They should take. And we don't take, generally we don't take idea-based startups, in
So in
certain
each startup,
cases, we are taking.
got it. Okay, in each startup, you have as a startup lane, from startup lane side, you have invested more than 25 lakhs.
25? No, we average ticket is like 1 to 30 crores.
Okay.
I thought you were asking about a startup in your kitty.
Okay,
So,
okay.
25 is the bare minimum they should take at least, right? But our ticket size is 1 to 30 crores.
Okay.
In Mother Singh 30, like average is like 2 to 3 CR.
Okay, okay. Yeah, as a follow-up question, so suppose you are telling it's already revenue generated companies, right? Like why do they need more money? Like is it like scaling or no? Are we funding to have them better scale?
Yes. So we don't invest in sinking ships. This is my original statement. We only invest to increase the speed. If you want to reach to the destination faster, and our destination is, I'll also tell you one more KPI that we check. We check on paper if the startup is not becoming a unicorn. That means 8,200 crore of valuation. If this is not happening on papers in next 5 years, then we don't take a startup. Right? The market has to be big. It should become a unicorn in next 5 years. If even on paper, if it is not happening, then we do not take that startup, and we go by the valuation multiple. So if suppose the 2x multiple is there in food, if the startup is able to show a revenue of 4,100 crores in next 5 years, then we can take that startup, else we don't. So that is most important. Anybody who does not have the vision of becoming a unicorn, then also we don't take them. Anybody who don't want to scale up the operation, who say, I just want to exit the company, selling of the company, we don't take that. Anybody who has mediocre vision, we don't take them. Very simple.
Okay. Yeah. Okay. So are you guys monitoring continuously? Suppose you have invested in 129 startups, right? So every month or so, you'll continuously monitor, and then whether they're progressing or not.
Yeah.
I mean, why I'm asking is, so in general, even the biggest VCs, right? They don't have, I think, in the startup like 5 to 10 success ratio only. Only 5 to 10 startups only getting successful. Remaining mostly, a lot of people are burning the cash. So are you guys continuously monitor?
Yeah. So in the market, what happens is people say only 1 out of 10 startups survive, but we are proud to say that only 1 startup did not survive out of our 129. Right, all the startups are happily running, and that 1 startup also is returning back the money. So our first priority is the safety of the capital. That is our first ever priority for our investors. And we are not looking for massive ROIs. This is also sure. You will not get such kind of deep tech opportunities at StartupLanes platform, because our investor base is not extremely mature investor base. Maybe after 2 years down the line, we will be having those deep techs coming up for a specialized set of investors. Those who had made money, those who want to make more money. But initially, right now, our objective is to secure the capital. That is most important task.
Okay. Yeah, one last final question. So apart from, say, suppose shared certificate or something we get on paper, so what is that collateral? Suppose I'm putting 1 crore, okay, through StartupLanes in one startup, okay, 1 crore or maybe 10 lakhs, 20 lakhs. So apart from shared certificate, what else I'll get? Is there any collateral we take from startup?
Yeah, there will be an agreement. If you are investing into optional equity mode, it will be in your term sheet and SHA both. If you are investing into compulsory buyback model, then you will get the checks, advance checks of the interest and the capital, both.
Mhm. So this
Right.
checks, right? I mean, we have invested in some companies, right? So they get bounced back, and then we need to fight a lot. Okay, at least so I'm from Hyderabad. We have seen at least 3 companies like where we invested. No, they don't process on time. They're very good companies. They're very, very good companies. But still, they say, okay, you just go ahead and then go with legal and all those things. They say.
So if the check bounces, then there is a jail of up to 6 months, right?
Yeah, that is there. But how about our money? See, if he is sitting in jail, so that we don't get anything, right?
So I'm sure that initial due diligence was missing at the time of taking the startup.
No, these are pretty good. It's not just startups, even matured mid-level companies. But anyways, I'm just asking. Like,
No, I'll tell you, there are methods to find out. Like if you check with the employees, with the buyers and sellers and the other investors, you will get to know the nature of the person, the founders, right?
Mm-hmm.
So if you do this due diligence like we do, I don't think so you will find, because generally who has this kind of nature, they will do something in the past also. They might have some notices coming to them. We take out everything. We ask for all the notices. All the disclosures are required initially at the time of due diligence.
Sure. Okay. Yeah. Fine. Okay. Actually, so we did the due diligence. There were no previous instances like that, but it happened. But I'll check offline of what more due diligence you guys are doing. Yeah. Thank you for the information.
We have a law firm also, SL Legal. So, probably we can assist you in recovering your money.
Perfect. Okay. Thank you.
All right. So I think we can call it a day. Thank you so much, everyone, for coming up. And from next week onwards, we'll be coming up with new demo days, which are on the basis of these 2 models completely.
Yeah. Thank you. Thank you very much.
Thank you, everyone. Take care.
Thank you.
Thank you.
Thank you.